I want to bring in Peter Bookvar of Bleakley Financial Group and a CNBC contributor, along with fast money trader Tim Seymour. Also joining me for the hour is Simeon Hyman, global investment strategist at ProShares. Gentlemen, thank you all for being here.
Thank you.
Simeon, I want to start with you. You and I were actually chatting before the show. We're seeing obviously turmoil in the markets. Where are you looking at for opportunities right now?
The challenge is, of course, rising rates and inflation. And I think what people get almost backwards in the equity markets is they say, OK, if interest rates are rising, I guess I have to have short duration bonds. And then the overgeneralization is, well, I guess I should have short duration equities. Except if you think that through, that means equities that aren't really growing. And that doesn't really make any sense because the salvation of equities is, of course, growth. And if you're looking for growth, one of the best sources of that is growth of dividends, because that's the thing you can't fake. I mean, the S&P 500 shrank its margins. Top line grew in the first and second quarter, but margins shrank. But if you look at stocks that have consistently grown their dividends, you see actual margin expansion, and that can be a real asset in this environment.
All right, so Peter, over to you. You had a note out today looking at the violent moves in bonds and currency. Are the opportunities right now in bonds, is that where investors should look for yield?
Well, yeah, for the first time in years, we have interest rates to actually capture. But I do think that from a duration standpoint, investors still need to be wary of longer-term bonds. I think short-term bonds are really attractive. I mean, the two-year Treasury note yielding 4.10, 4.15, while it's still well below the rate of inflation, it's a yield that I think people should take advantage of. I don't think the Fed is going to get the Fed funds rate much above 4%. And I think in the next couple of years, they're going to be cutting interest rates, maybe not back down to zero. But I think the short end of the Treasury yield curve is very attractive. And also, the TIPS market has been re-rated downwards. Everyone just assumes that inflation is going to quickly go to 2%-ish, 2.5% maybe, over the next 5 to 10 years. And I think that's optimistic. So I think there's also opportunities in the TIPS market as well.
So, Tim, I saw you nodding when you talked about the TIPS market, but I want to talk to you about something that we've been talking about on CNBC probably for a lot this year. Tina, there is no alternative to stocks. Has that narrative completely changed with what we've seen today?
Well, so what equity markets did today and the spike in the VIX and the things that were part of this central bank madness week, but this today was about policy error. This today was where equities and currency markets, frankly, and I guess, bond markets like UK gilts, you look at what they did, the Reaganomics in the UK, and you look at the dynamics here of where we've seen central banks. Investors are fearful of policy error. And that, to me, is a place where obviously people are estimating, in different asset classes, where is there room to run and hide? If you look at, Peter's right. I mean, like between, probably around 18 months out on the Treasury curve, relative value and duration-wise is a pretty interesting place to be. When you listen to the Fed this week in Powell's testimony or his comments after the announcement, there was questions and ultimately asked, does the Fed want to get to positive real rates before they even pause? And we all can do that math. That's where equity markets are, again, talking about and concerning over policy error. So, yes, there are alternatives. And I would just point out that consumer staple stocks, look at the week that General Mills had. Look at Kellogg's. Look at Colgate-Palmolive. Again, they are growing their dividends. They are free cash flow generating companies. Yes, they are expensive, but we've seen this before. And I think these companies will trade expensive because they're maybe no other alternatives in the equity market than finding the best companies. And I actually do think you should be short duration equity. I don't want to be in high multiple stocks. I don't want to be buying growth here. I just don't, not wholesale. But I think the market is telling you that we still haven't worked through the pain of where interest rates go.
So I understand what you're saying. You want to stay defensive right now, looking at those consumer staple stocks. Are there any other individual stocks you can identify right now? I know I'm putting you a bit on the spot where people can run and hide. I mean, if you look at what happened today, Home Depot, the best performer in the Dow and the S&P.
I like Home Depot. I think Home Depot on the charts, and I look at, I have levels on a lot of stocks. I'd like to own it closer to 245 than I want to own it here, and we may get there pretty quickly. But I look at the energy sector, which was thrown out the window today. And again, I'll get back to the same thesis. A company like Chevron or a company like Diamondback or they're going to pay 25% of market cap in free cash flow this year, and they're going to give it out to investors. The payout rates in the energy sector are substantially higher than they've ever been, and probably higher than almost any other sector. These are companies that are run differently. So there are opportunities for investors in this marketplace. And I would also point out that we've had 8 or 9 moves of plus or minus 8% in the S&P already this year. I mean, there have been trading ranges. Nothing is predictable except in hindsight, except for the fact that we have had opportunities to be trading around ranges and important events. And I think investors should not lose sight of those opportunities.
All right, Peter, we got to get moving. I want to give you one last word before we go.
I actually agree with Tim on the energy stocks, and he makes the right point that the free cash flow yields, even at $80 oil, $6, $7 natural gas, is in the 20+% range. So these sharp pullbacks, because people are panicking about the price of oil, which I understand because they're worried about the demand side, I think the supply side is so crimped that prices aren't going to fall that much further from here.
All right, Peter and Tim, thanks for being here.